In the last 12 months, the S&P 500 hit record highs. The dollar strengthened against most major currencies. Your portfolio probably looks great. And that's exactly why this matters. Because in those same 12 months, quietly, without headlines, something very different happened. The world's three largest sovereign wealth funds reduced U.S. exposure. Saudi Arabia signed a $50 billion currency swap, bypassing dollars entirely. Central banks bought gold at the fastest pace in 30 years. Two opposite realities. Both true. One is visible, account balances, market charts, reassuring headlines. The other is structural, happening underneath the system that made those gains possible. And the most dangerous part is, nothing feels wrong while it's happening. The hidden one determines which reality wins. Right now, the system that made U.S. assets feel automatically safe for the last 80 years isn't collapsing. It's being reorganized. And if you're waiting for headlines to tell you when to react, you're already positioned exactly where every reorganization wants you, holding the thing that's being reorganized away from. This has happened before. Quietly. Gradually. While everything still looked fine. Let me show you the pattern, and why seeing it late is the same as not seeing it at all. 24 years ago, the US dollar made up 72% of global foreign exchange reserves. Today, 56.3%. That's a 16-point drop, the largest peacetime decline of any reserve currency in recorded history. And it's accelerating. Q3 2025. Norway's $1.4 trillion sovereign wealth fund cut U.S. allocation by 3%. Q1 2025, central banks bought 776 tons of gold, the highest pace since the early 2000s. These aren't forecasts. These aren't opinions. These are positions already taken. Most people holding U.S. assets don't realize they're already on one side of a global reorganization, not because anything broke, but because nothing did. Reserve currencies don't lose power when they collapse. They lose power while everything still works. Here's what that looks like in real life. Right now, millions of disciplined investors share the same structure. Heavy U.S. equity exposure, treasuries for safety, cash in dollars. Little urgency to change, because nothing feels wrong. It survived 2008. It survived 2020. It's working right now. And that's exactly why it's vulnerable. Let me show you one version of this position. David is 52, $1.2 million saved. Maxed his 401k for 20 years. Index funds, low fees, discipline. His allocation, 60% S&P 500, 30% treasuries, 10% cash, textbook safe, and it worked perfectly. 8 years from retirement. Statements are green. Every signal tells him he's doing the right thing. 3 months ago, his advisor emailed, David, we should talk about international exposure. David ignored it. Why wouldn't he? Markets are up. America has the most powerful companies, the strongest military, the deepest capital markets. Why dilute exposure to the safest system on Earth? His advisor didn't push, just said, let me know if you change your mind. David didn't, because everything confirms he's right. But 6 months before that email, his advisor had already started moving. David's advisor manages $400 million, not just for guys like David, for family offices, small institutions, people who move before headlines. Late 2022, he started seeing something in the data, not on CNBC, in central bank reserve reports, settlement systems, commodity contracts. Signal 1, March 2024. Saudi Arabia, America's most critical Middle Eastern ally for 50 years, accepted payment for oil in yuan. Not for all contracts, just one. David never heard about it. His advisor noted, first time in 48 years the petrodollar monopoly has been broken. Signal 2, July 2024. Central banks globally bought 776 tons of gold, one of the highest annual rates in modern history. Not for dividends, for hedging. Signal 3, Q2, 2025. The dollar's share of global foreign exchange reserves hit 56.3%, down from 72% in 2001, the largest sustained decline in any reserve currency in peacetime history. David's advisor didn't see collapse. He saw insurance behavior. When the world's most sophisticated institutions quietly diversify away from something, they're not panicking. They're reading a pattern. And that pattern has happened before. Let me show you what David's advisor was remembering. London, 1900. The British pound is the world's reserve currency. Trade globally? Use pounds. Borrow for a major project? Pounds. Hold savings? Pounds. The British Empire controls 25% of Earth's land, 400 million people, the most powerful navy, the most advanced industry. This is the peak. Now watch what happens over the next 70 years. 1914 to 1918, World War I. Britain wins. But the war costs $35 billion. Britain borrows heavily from the United States. Pound stays dominant, but cracks appear. 1931, Britain abandons the gold standard. Pound devalues 25% overnight. Countries holding pounds lose billions. Trust erodes. Still the reserve, but alternatives are discussed. 1944, Bretton Woods. The dollar officially becomes the world's reserve currency. But here's what people miss. The pound didn't collapse in 1944. It remained a reserve currency for decades. Central banks held it. The Commonwealth traded in it. Still safe. 1992, Black Wednesday. Pound crashes out of the European system. The pound outlived the empire by 50 years. Critical lesson. People who waited for dramatic collapse missed the entire transition. The pound lost power for 70 years while still functioning. British savers holding 100% pounds in 1920 didn't go to zero. They just bought less every decade. By 1970, 80% purchasing power gone. Same account number. Completely different lifestyle. The transition leaked. It didn't explode. By the time it was obvious, the wealth transfer was complete. Here's the mistake people make. They think replacement is a moment, a clean handoff. It isn't. It's a 70-year downgrade that feels normal the entire time. British investors in 1950 thought, the pound is stable, everything's fine. They were right, and completely wrong. Their wealth was being taxed by reorganization, and they never felt it until retirement. Back to David. David checks his portfolio tonight. Up 12%. Treasuries pay 4.5%. Index funds hit new highs. He thinks, everything's working. And he's right. For now. But here's what he's not tracking. The American Privilege Premium. For 80 years, U.S. assets had automatic advantage. Lower borrowing costs, higher valuations, automatic demand. That premium is eroding. David's S&P fund, up 12%. Emerging markets, up 19%. His treasuries, 4.5%. Foreign inflation-linked bonds, 6 to 7%. The gap is closing. David doesn't notice. He's still making money. But the system is taxing away the privilege his dollars carried. Same behavior, different outcome. David's father retired in 1995 with $800,000. Lived comfortably 30 years. David retires 2032 with $1.2 million, 50% more money. Won't stretch half as far. Not because he failed, because the currency premium is disappearing. Right now, the global financial system is being replumbed. Not collapsed, rerouted. China's digital yuan, $2 trillion processed by September 2025, designed to bypass dollar clearing entirely. BRICS, bilateral trade settling in local currencies. Brazil, China, India, Russia, ASEAN corridors. Commodities, oil in yuan, gas in rubles, metals in rupees. This is infrastructure already operational. Same process as the British pound 1920 to 1970. Trade rerouted. Reserves diversified. Rails built outside the dominant system. None sudden. All structural. David won't see a headline. Dollar no longer reserve currency. That headline never comes. Reserve currencies don't die in explosions. They downgrade while functioning. By the time it's visible, reorganization is complete. David's advisor moved his family's money 2 years ago. Not because the dollar will collapse. Because reserve transitions reward people who see the replumbing early. This isn't about panic. It's about seeing the pattern while it's forming. Here's what to track. 1. Which trade settlements bypass dollars? Not headlines, actual contracts. China-Brazil oil, India-Russia energy, ASEAN corridors. Every bilateral deal skipping dollars is a pipe rerouted. 2. Where sovereign funds reallocate. Norway, Saudi Arabia, Singapore, Abu Dhabi. They read structural signals years early. 3. What percentage of reserves are diversifying? Not abandoning dollars, shifting 70% to 60% to 55%. That 10 to 15% represents trillions repositioning. These show what's already happening, quietly, structurally, inevitably. David still hasn't called his advisor back. Portfolio still up. Statements green. Everything looks fine. And that's exactly the point. Reserve currencies don't collapse when obvious. They lose power while everything looks stable. The pound didn't collapse in 1945. Outlived the empire 50 years. People waiting for the moment missed the transition. The system isn't breaking. It's reorganizing. People who see early won't ask permission to move. They already understand. The game didn't end. The rules just changed. Welcome to Geopolitics of Money.